All right, everyone, I hope you're comfortable because this is going to be a long one. In this video, I'm going to go over from start to finish how to value a business using the discounted cash flow approach and explaining the steps along the way. So this video is going to be designed for people who are relatively new to investing and are specifically interested in learning how to actually properly value a company and look at the future cash flows that they can expect a business to generate, discount them back to their present value, and value a business that way. In my opinion, this is the best skill that pretty much any new investor out there can learn because it gives you a very clear direction when you're investing, and it can help you make more high conviction investments that are supported by legitimate, diligent research rather than just speculation and making random guesses as to what stock price you should buy and sell at. And we're going to use the Canadian railroad behemoth, Canadian National Railway, as our example for this for a few reasons. One, I actually want to take a look at this company and value it myself, but also because it is a very stable company with very predictable cash flows, and it's pretty easy to value using this method. So it'll make for a great example. It is a mature company as well. So I think overall, it's going to be a great learning experience for people who want to learn how to use the discounted cash flow approach. But before we jump into the actual mechanics of the discounted cash flow approach, I want to talk just in general about valuing businesses. So I have Microsoft pulled up on the screen here. Specifically, I've got their income statement where we can look at their total revenue, their operating expenses, their net income. But for the discounted cash flow approach, what's more relevant to look at is the cash flow statement. And specifically, we'll scroll down here and look at free cash flow. So this company generates an insane amount of free cash flow. And there's a reason for that. Microsoft, as of making this video, is the most valuable business in the world, valued at about $2.6 trillion. So why is it valued that much? Well, it helps to think of pretty much companies in general as just cash flow generating machines. They're not businesses. What they are is cash flow generating machines. Now, some companies are very, very good at generating cash flow. For example, Microsoft, right? This company, as we can clearly see by their cash flow, they generate an insane amount of cash flow. Apple is another great example of that, which is why they're so valuable as well. The Aramco Saudi business is another great example of that. All these businesses generate insane amounts of cash flow relative to the costs that they have to incur in order to generate that cash flow, as well as the actual capital investment that needs to go back into the business in order to maintain those high levels of cash flow going forward. But some companies are different from that, right? Microsoft, just one example. But let's take a look at another company called Snowflake. So I'm going to go to their summary page here so we can look at their market cap. So currently Snowflake is a $109 billion company. So it's a big company. Now, if we look at their financial data, so the same data we were just looking at with Microsoft here, go to their financials. We'll go to the cash flow statement. And then we scroll down to free cash flow, and their free cash flow is negative. Right. So that seems a little odd from a valuation perspective. It's $100 billion+ company, but it doesn't generate positive cash flow. So why is this? Are investors just on crack and they don't understand basic valuation? No, not necessarily. But what this does tell us is that investors expect the company to be very effective at generating cash flow in the future. They're going to be a very strong cash flow generating machine in the future. They're not there yet, but based on what they can tell about the company, it's likely that they will be in the future. Whether or not that actually happens is for you to decide as an individual investor, but that's what it tells you. And you'll often find that stock prices can fluctuate significantly depending on changes in investors' perceptions of a business's future cash flow generation capabilities. And this is why you often see biotech companies just jump at 40% in value in one day. Because, for example, if they receive FDA approval for a new drug to begin commercialization on that new drug, that will significantly alter the future cash flow generating potential of that particular business. Now, many companies are very different. We saw the timing of cash flows be different. For example, Snowflake, they're expected to earn their cash flows far out to the future. And because we discount those cash flows, which we'll talk about, cash flows that are worth or cash flows that are earned in the future are worth a lot less than cash flows earned today, which is in contrast to Microsoft. They're earning a lot of cash flow today and will probably be earning even more cash flow in the future based on what we can tell about the business. Now, if we take a look at a company we looked at recently on this channel, Canopy Growth. So Canopy Growth is kind of similar to Snowflake, where if we go to their free cash flow, it's also negative, and it's very negative. In fact, even more negative than snowflakes. But this company is worth less than Snowflake. And the reason is this company's cash flows are highly, highly uncertain because how much money or the future cash flow generating potential of this particular business is very dependent on the outcome of many future events, which are largely outside of the control of general stock market investors. So we can see their stock prices fluctuated a lot. It's gone up, it's gone down, it's gone up, and it's got down. So why is that? Is it because the business has fundamentally changed? Not necessarily. It's because perceptions of their future cash flow generating ability change very dramatically depending on whatever news is coming out with legalization of recreational marijuana use and different states allowing it to be legal, all that type of stuff, right? But now let's actually look at the company we're going to take a look at, which is Canadian National Railway. That's CNR. Yep, there we go. So this is their max chart. So it goes back to 1996 here. We can see it's pretty stable. It's gone up. So what does this tell us? This is probably a lower risk business, right? It's probably not growing at insane rates. It's growing very stably over time. It looks like it's compounded a bit. We take a look at their financials. And then again, we'll go back to that cash flow statement because again, really the only reason why any business has legitimate value is because of its ability to generate future cash flow. So we go down to cash flow and there we can see it's generating 4 billion in free cash flow. And then it's also been growing. So it's growing and it's currently generating strong cash flow. That's why a business like this is as valuable as it is. Now, when it comes to understanding the discounted cash flow approach to valuing businesses and valuing stocks, you really have to understand the concept of enterprise value. So I put up the basic formula for it on the screen here, but I also kind of want to explain it conceptually as well to help more beginner investors understand it. So it helps to view companies as if they're pies, where the pie is split up between the debt holders of the business, which is typically banks that lent the company money, or bond holders if they issued bonds as a way of raising financing, and equity holders or stockholders, common stockholders, and in some cases, preferred shareholders, which are a bit different than common stockholders. Now, when we think of investing, typically we think of investing in the company's common stock, and that's ultimately what we're trying to value when it comes to the discounted cash flow approach. But enterprise value is really the value of the business as a whole. So that includes all the different claim holders, which refers to preferred shareholders, common shareholders, and debt holders on that business. So we already know that companies are just cash flow generating machines, right? But the other piece of the puzzle to understand how that cash gets divided among the different claim holders of the business is very important, which again means the debt holders, preferred shareholders, and common stockholders, because businesses, they finance themselves or they finance their operations in many different ways. And depending on what type of an investor you are, you do have different rights depending on the type of security you own. For example, if you're a debt holder or you own bonds in a business, or you're a bank that lent money to that business, your only upside is just the repayment of interest and the principal amount that you lent to them. So if the business that you lent money to becomes super successful, you don't get any additional benefit from that. The only benefit you get is not having the company go bankrupt and not being able to pay you back. But the advantage is if the business fails, you get all your money paid to you before any of the preferred shareholders or the common shareholders. So you have liquidation preference, that's what it's called, over those claim holders. And then similarly for preferred shareholders, your upside is limited to only the annual dividend that has been paid on those preferred shareholders. Usually it'll be described in the preferred share offering what the annual dividend rate on them is. But if the business fails, you do rank ahead of the common shareholders, but after the debt holders. So you do have a bit better downside protection. So this blend of different ownership structures for a business, it's referred to as capital structure. So often when you hear people use the term capital structure, they're referring to the different combinations of ways businesses have decided to value themselves. And you also often hear the term market cap, and market cap simply refers to the value of the equity portion of the business. So it's not the enterprise value. Enterprise value it includes market cap, but on top of that, you have the debt, or net debt, as what it's called, which net debt means the total short-term and long-term debt of the company minus their cash balance and their short-term investments they can usually convert into cash. Then you also add the balance of preferred shares on top of that. So it's all those things combined together make up enterprise value, whereas market cap is just the value of the company's equity. Another way to think of it is if you're buying a home, say it's $1 million home and there's a $600,000 mortgage and a $400,000 part that's paid off, known as the equity, the market cap would just be the $400,000 equity part of that home. And then relating that to business, it would be the market cap. Okay, so now we know that businesses are just cash flow generating machines that vary in their cash flow generation effectiveness. We know that that cash flow is split amongst different claim holders of the business, preferred shareholders, common stock holders, and debt holders. And when you buy a company's public stock, you're becoming a common shareholder of that company, which gives you a right to own a share of the future cash flow that that business generates. So the value per share is a function of, again, the perception of the future cash flow that the business can generate and the actual cash flow that it ends up generating over the long term. You often hear the term in investing in the short term, the stock market is a voting machine, and in the long term, it's a weighing machine. And what that means is in the short term, stock prices will fluctuate depending on investor sentiment, social media, news that comes out about a company. But in the long term, it's going to depend on the actual fundamentals. So the free cash flow that it generates, how much of it returns to investors, how much it reinvests back in the business, and how successful they are at reinvesting that cash flow to then generate more cash flow into the future. All those different fundamental indicators. And the price that you pay for common stock, it changes every day. Again, the price per share times the amount of shares they have outstanding. That's called market capitalization. So every day the public markets are open, they're going to tell you what they think that company's future stream of cash flows is worth, how much that cash flow generating machine is worth. And your job as the investor is to decide whether or not you think the market is correct for whatever business you're looking at. Again, we're going to go through Canadian National Railway in this example. And again, you'll often hear the term, any investment is the present value of all future cash flows. But what does that actually mean? So I want to illustrate this with an example here. So this is going to be a super simplified example. Now, basically, let's just assume that you have the opportunity to buy a business. And this business, you have perfect information and it's expected to, over the next 10 years, so I'm just going to write out the years here. So 10 years, and then we'll do FCF, which is free cash flow. Now, later on, I'm going to get into the different types of free cash flow, but let's just assume for the sake of it that this is a debt-free business, no preferred shareholders either. And it's going to generate just $10 in free cash flow every year for the next 10 years. And the market is telling you that it thinks this business is worth $100. Now, again, when you're doing this in real life and you're actually investing, you don't know what the future free cash flow is going to be, but you're going to be quoted a market price. So let's assume in this case that the market is saying, I want to pay $100 for this future stream of cash flow. It's going to pay me $10 a year at the end of each year for the next 10 years. So you're paying $100 for the business now, and it's going to generate $100 over the next 10 years. Is that a good investment? The answer is no, because, well, you're not making any money. You're paying $100 now to receive $100 in the future. That's not really a great investment. So if you did have perfect knowledge of this investment and you knew exactly what the future free cash flows were going to be, again, it's not really realistic, but for the sake of this argument, let's say that was the case, you would not make the investment. But let's say the next day, the market is now quoted $50 for the exact same future stream of cash flow. So it's $50 to receive $100 over 10 years. Now I'm going to show you how to do the math on that. So the way you do it is you do the total amount of free cash flow it's going to generate in the future. If you wanted to calculate your return on this investment, you divide that by the amount you paid, and you put that in brackets, and then you do to the power of 1 divided by the number of years, which in this case is 10, minus 1, and that's going to give you a percentage return. So your percentage return in this case would be about 7.2. So that's an okay investment, right? 7% is a decent return, but it's also important to keep in mind the opportunity cost, because you could invest in broadly diversified index funds, which on average will return 9 to 10% over long periods of time. So if you're investing in an individual company, you're taking on additional risk. This is something I talk about a ton on this channel. You deserve to be compensated for that additional risk you're taking on. So you should ask for a higher rate of return. Now, again, this is a completely debt-free business. So this is only the cost of equity that we're talking about here. But then let's say the next day it goes down to $30. Now, you're only paying $30. We would change this again for the exact same future stream of cash flow, $10 a year every year for the next 10 years. Now your return goes up because you're paying a lower price. If you want to increase the potential return you can earn on an investment, you have to pay a lower price for it. So whenever you hear someone say any investment is the present value of future cash flows, they're referring to this, because even if this wasn't a business, this was just, say, a bond investment, right? And you knew exactly what your cash flows were going to be for the bond investment in the future because there's a predefined schedule of when you're receiving your payments. Then you would know with pretty good certainty, unless the business fails, that what your future stream of cash flow is going to be. But with equity investments, it's different because you don't precisely know it because it depends on how successful the business is. So this is in essence what investing is. You're paying money now to ideally receive more money in the future. And you're paid for taking on risk because some cash flows are more certain than others, right? In this case, we were assuming the cash flows were certain, but in real life, we don't know what these cash flows are going to be. They could be negative for pretty much this whole period. They could be much higher than we're expecting. We just don't know. That's part of the whole research process. But when we're thinking of investing, just by defining it as what it is in its essence, it's paying money now to receive more money in the future and taking on risk. Okay, so now we have a good understanding of the essence of what valuation really is. It really comes down to projecting the future cash flows of the business and discounting those back to the present. Now, projecting future cash flows for any business, really, even a business that's as predictable and as stable as one like Canadian National Railway, is going to be pretty difficult because there's always going to be some variance in it. And it helps to first identify what stage in the business life cycle the business that you're looking at is in. And there's really a few main stages for the business life cycle. You kind of have the startup phase, which is when a business is very new. It's very, very difficult to value a business in that stage. Then you get to the growth stage, which is when you're looking at metrics like sales growth and EBITDA growth, more so than cash flow generating potential, because perhaps the business isn't even cash flow positive yet, similar to what we saw with Snowflake. Then you get to the maturity or the plateau phase, which would probably be a business like Canadian National Railway, because they are still growing their revenue, but they're growing at a much slower rate and their business is well established in the market. And then you have the decline phase. So when businesses get older and they start to decline, their products and services are no longer as relevant as they once were. Sales are falling, profits, cash flows are all falling as well. So you have to kind of identify what stage in the life cycle the business is. And then that's really going to determine how you project their cash flows going forward. But it also helps to understand what the cash flows were like in the past, which is what I've done here. So there's two types of cash flow. There is free cash flow to firm, also called unlevered free cash flow. And then there is free cash flow to equity, which is also referred to as levered free cash flow. Now, these two types of cash flows are calculated differently, as you can see here. Now, free cash flow to firm is referring to the free cash flow that's available to distribute to all pieces of the pie. So all the debt holders, the preferred shareholders, if there are any, and the common stockholders, whereas free cash flow to equity is just the cash flow that's available to be distributed to the equity holders. Now, when you're discounting those, we're going to get into how to determine the discount rate later. But just as a primer to that, when you're discounting these cash flows, when you're discounting free cash flow to equity, you're only using the cost of equity. But when you're discounting free cash flow to firm, and this is what we're going to focus on for this model, you are discounting using the cost of capital, which is a blend of the cost of debt and the cost of equity and the cost of preferred shares, if there are any. There aren't any in the case of Canadian National Railway, though. So the way you calculate them is I've got revenue here, but for free cash flow to firm, you take EBIT, which is earnings before interest and taxes. You then take out the taxes paid. You then deduct capital expenditures, and then you add back depreciation and amortization. And the reason you do that is because depreciation, amortization, it's an expense that you'll see on the income statement, but it's a non-cash expense. It's really just an accounting calculation. It's designed to capture the effects of how equipment and intangible assets lose value over time, because as you use them, there's wear and tear on them, or certain intangible assets may have a predefined life, like a patent that's only available for, say, 10 years. So the way accounting rules account for that is by taking depreciation and amortization. But since it's a non-cash expense, you have to add it back in order to calculate free cash flow to firm in this case. And then you also deduct working capital investments. So I have a history of the last 7 years of Canadian National Railway's free cash flow to firm. And you can see with the working capital investments, sometimes they have to make them and then sometimes they don't. It really just depends on kind of the timing of the financial statements. And working capital is referring to items like inventory, accounts receivable, accounts payable. So if a company has to buy a bunch of inventory, that's a necessary cash flow that they have to make, that's cash outflow in order to continue to keep the business operations running. Now, free cash flow to equity has a bit fewer line items. You take just cash flow from operations. Again, you deduct your capital expenditures, but then you add or deduct any debt issuance or debt repayments. So that's how you're accounting for debt in this case. And then you do the same thing with preferred shares. So if the company issues debt, that actually increases free cash flow to equity, which may seem a little confusing, but the reason it does that is because if a company issues debt, that is a cash inflow that they received, which they could in theory use to pay dividends, buy back stock, make acquisitions, and all those different types of things. So because of that, it is included in free cash flow to equity. And then it's a pretty similar concept with preferred shares. Now, for the purposes of this, we're going to focus on free cash flow to firm. And the reason for this is because a company like Canadian National Railway, their free cash flow to equity fluctuates a lot. It's an asset heavy business. As a result, they have to borrow a lot of debt in order to finance those assets because they're longer term assets, which means they're going to have longer term debt, which is associated with those assets. That's generally how they finance it. So if they paid down a large amount of debt, their free cash flow to equity could actually be negative. In this case, in the year 2018, it was negative because they paid down about $2.4 billion in debt. But obviously with a company like this, that would indicate that, they generated no cash flow that year. So what's more representative is to look at free cash flow to firm. It's a lot more stable year to year. It's a lot easier to project because our starting point is revenue, and then we can take an EBIT margin off of that revenue. And then from there, we can determine what we think their capital expenditures will be, what their taxes paid will be, which is pretty easy to determine just based on historical tax rates. We can also calculate their depreciation and amortization, as well as any working capital investments that they may make. And something else I want to highlight is why we look at free cash flow as opposed to net earnings or net income, or also called profit, when we're looking to value a company. And the reason for that is because profit is really just an accounting calculation. There is, for example, depreciation and amortization. There's many different things that go into the profit calculation that aren't really indicative of the economic value that the firm is generating. And you as a common shareholder, the way you get paid back is if the company buys back some of their shares, or if they pay dividends, or if they make an acquisition, which makes the business more valuable, or even if they just keep that cash and just leave it in their bank account, right? Because you own the business. If they just take the cash they generated, they don't do anything with it, they just keep it in the bank, you own part of that bank account. So you are seeing that value. Even if they aren't directly paying it out to you, you still do see that value increase in the value of your shares. So that's really why I personally prefer looking at free cash flow and valuing businesses using the discounted cash flow approach, just because it really tells you pretty precisely what the economic value of that business is and how you're going to get paid back as a common shareholder. Okay, now let's get into the next step of doing the discounted cash flow approach, which is we have to determine our cost of capital, which is the rate we're going to discount those future cash flows that we project at. So because we're calculating free cash flow to firm in this case, which again is the cash flows that are available to all claim holders of the business, debt holders, preferred shareholders, and common shareholders, we have to calculate the cost of capital as a blend of the cost of equity and the cost of debt. This company does not have preferred shares in this case, so we don't have to worry about that. Now, this is the rate we're going to use when we're discounting all those future cash flows. And normally on my channel, I'll use a rate of 15%, which is my required rate of return or hurdle rate, as it's often called. And I do that when I'm calculating free cash flow to equity, because I'm essentially saying, I want my investments to generate at least 15% return for me. Because if I'm going to take on the additional risk of investing in an individual company, I'm going to want to make sure I'm adequately compensated for it. And the way I ensure that is by basically forcing all the investments to earn me at least 15%, which means I have to get them to a low enough price where I will earn 15% projected on my investment. That's what I want before I start to consider them. But what we're doing here is a little different, all right? We're trying to calculate this company's cost of capital, which is a blend of both cost of debt and cost of equity. Now, cost of debt is really just the interest rate. It's pretty easy to determine cost of debt, which I have here. I just did it very simply. I took the book value of debt, so that can be long-term debt plus short-term debt. So anything that has interest attached to it, you may have to read the notes of the financial statements of the company on all the different types of debt they have in order to actually determine that. And then I just took their interest expense. So I took what it was in the most recent quarter, which is 197 million. I multiplied that by 4 to prorate it for a full year, and then just divided the two. So this 5.8% here is just this number divided by this. Then it gives us about 5.8%. So that's a very simple way to do it. There is some nuance to calculating this, and some people may have some different ways that they get a more accurate picture of the debt. But by and large, doing it this way, you'll get ballpark what the cost of debt actually is. Okay, next let's move on to determining the cost of equity. So you can see we have a few different inputs. We have the risk-free rate, the market risk premium, and the beta. So the beta of the company. Now let's start with the risk-free rate. So I'm currently using the average 10-year treasury yield on Bank of Canada government debt, which is 2%. So risk-free rate refers to the amount of return that an investor could earn completely risk-free, which usually for that, you're going to refer to government debt, right? Because government debt is generally seen as risk-free. So how did I get this information? Well, it's pretty easy. I just went to the Bank of Canada website. I looked at the average yield on 10-year treasury bonds, and we can see it's about 2%. It's kind of hovering depending on the date, but it's around there at 2%. Now, some people will use the 30-day treasury yield. Some people use the 10-year treasury yield. There's a bit of a debate when it comes to determining cost of equity, which one is better. But here I'm using the risk-free rate for 10-year treasury bonds. Now, the market risk premium, this is the average expected return on an index, which is generally going to be in the range of 8 to 10% minus the risk-free rate. So I have 6% in here because I used 8% as the expected return on the index minus the risk-free rate. Now, the reason I used 8% is because it's expected to be a bit lower in the coming years, just because currently the stock market is at all-time highs. Some people may use 10% as the average expected index return, in which case their market risk premium would be 8%. Again, there's going to be some debate and some nuance when it comes to the actual mechanics of these calculations. But for the purposes of this here, we're going to go with 6%. So market risk premium, that's essentially the added return you get by taking on the additional risk of investing in the index as a whole. Now, beta, this is a metric that some of you guys probably have heard of. It attempts to capture the risk inherent in an investment. So beta for CNR is 0.65 as of making this. And the way you can get this information is you just go to Yahoo Finance, for example, and they have it here. So you can see 0.65, that's your beta. Now, what it means is it essentially measures how volatile a company's stock price is in relation to the index, to the stock market as a whole. So a beta of 1, for example, would mean that If the stock market as a whole goes up 1%, the stock also goes up 1%. But a beta of 2 would mean if the stock market as a whole goes up 1%, then the stock you're looking at here would go up 2%. So it's more volatile because also if the stock market went down 1%, then beta uses historical data as well. So historically, on average, if the stock market went down 1%, a company with a beta of 2 would mean it would go down 2%. So it's more risky, right? Companies with higher betas are more risky. If you see a company with a negative beta, that means it's correlated kind of the opposite way of the market as a whole. So that's generally been unusual. But because this company is a beta of below 1, 0.65, that indicates it's lower risk. Its stock price is less volatile than the expected index as a whole. So because our beta is lower, that's going to decrease our cost of equity, because the way this is determined, the cost of equity is you just take the risk-free rate, you add the market risk premium to it, and then multiply it by the beta. So because our beta is below 1, our market risk premium aspect of this calculation is actually going to be lower. So that's how you calculate cost of equity. You can see it's actually pretty similar to cost of debt, which most of the time cost of equity is going to be higher. Okay, so we've got our cost of equity, we've got our cost of debt. Now we have to also look at their capital structure. So we can just go to their balance sheet and then we could take the total amount of debt, which it's super simple to do, especially for this company because they present their balance sheet in a very understandable way. Just look at their short-term debt, so on the current portion of the balance sheet, and then their long-term debt. And then you just add those together and then you can get total debt here. Now, some people will try and calculate the market value of the debt, which is really what you should use. But I think for this company, it's going to be pretty similar. So just to keep things simple and understandable, I'm just going to use the value of debt as it appears on their balance sheet. And then their market capitalization is going to be the equity portion. So you just go to whatever financial site you use, take their market capitalization, you put it in here, and then it helps you determine that. And then you want to take a percentage balance between these. So it's about 10% of this company is financed through debt, and then 90% is market capitalization. So, and we also have to look at tax rate. So this is our cost of capital calculation down here. You can see it kind of takes into account many different things. But for the cost of debt, you have to reduce it by 1 minus the tax rate. So I calculated effective tax rate here, just using their most recent financial information. So just took income before taxes, the taxes paid, and then whatever percentage that is, that's the effective tax rate. So it's just this number divided by this number. And the reason for that is because interest expense is actually tax deductible. So when you're calculating the cost of debt is going to be reduced by their tax rate, because when they pay that interest expense, because that's what's deriving the calculation of their cost of debt, they're saving taxes by making those interest payments. So that's why you could see here the sales C15, which is the percentage allocated to debt, is multiplied by the cost of debt, which is then multiplied by 1 minus the tax rate. So it reduces the cost of debt to account for the tax saving effect, which reduces the cost because they do save taxes by paying that interest expense. So with all that in mind, we get about 5.76 as our cost of capital. So that's the rate we're going to discount this company's future cash flows at. Now, what this essentially represents is the return the company would get if they kind of bought their own shares. And it's also important to look at, in context of the cost of capital, their return on invested capital. And you have to make sure that the return on invested capital is higher than the cost of capital. Why is it so important that return on invested capital is above cost of capital? Well, if you think about it logically, the cost of capital represents what the company has to pay to acquire capital. Capital is what they use to buy equipment, in this case, buy new railways to then, run their operations on, and they can charge fees to their customers on that and all that type of stuff. And their return on invested capital is how much money that they earn from investing that capital, right? What their net income is based off of that. And the 5-year average is 16%. And in the trailing 12 months, it's 15%. So because their costs to acquire that capital are less, about 10% less, than the return that they can earn by investing in that capital and making those investments, acquiring the assets, and then running their business operations and earning money in those operations, the company's generating positive economic value, right? They're generating value for shareholders. So the larger the difference between the return on invested capital and the cost of capital, the more profitable a company you can imagine will end up being. And ideally, you are going to have to pay a premium for companies that are generating a much higher return on invested capital than their cost of capital, right? Because they're low risk investments that generate a lot of money, right? Those are the type of businesses that we love because they make a lot of money and they're not that risky. They're stable. So it means they're going to be safe investments that will likely pay us well into the future. So because of all those qualities that are desirable investment qualities, you are going to have to pay a higher price. And that is going to be reflected in our actual discounted cash flow model, which we will get into next. Okay, so now what you're looking at is the actual discounted cash flow model for Canadian National Railway. So here in the orange, I've got my assumptions. So these are my assumptions of what I think the future is going to look like. And I've done about a 6.5 year projection for this business. So there's two stages to the discounted cash flow model. There is the kind of the higher growth phase, which in the case of Canadian National Railway isn't going to be a super high growth, but it's the phase where you're projecting revenue growth to be at a given rate. You can either use a constant rate or you can use a varying rate if you think growth will be faster, say in the earlier years, and then slow down later on. And then the second part is the terminal phase. So the way we calculate terminal value is we essentially take a multiple of the last year of our model, which is 2027 in this case, and then we multiply or use that multiple to determine what the terminal value will be. So I'll explain how to do all that in a second. But first, I just want to go through the assumptions that I used in this model. And again, we're calculating free cash flow to firm here. So these are all the cash flows that are available to be distributed to all shareholders, common shareholders, preferred shareholders, and debt holders of this business. So revenue growth, I put at 3.75%. Now, if we go back to the historical financial statements, we can see over the last 7 years, it was about just under 2%. But a big reason for that was because 2020 was a really down year for them. So I think it makes sense to assume that this company will recover from that. And if we look at what their revenue actually ends up being under 3.75% growth, in the year 2027, we're assuming it's just under $18 billion, which that might be slightly optimistic, but I think overall it is reasonable. Then we want to determine what their EBIT margin is, which again is earnings before interest and taxes. It's pretty similar to operating income as well. It's essentially the same thing. So in 2021, I'm assuming their EBIT margin will be 40. So let's look at what it's been historically. So it has been 40 in the past, but in more recent years, it's kind of dropped down. Now, I took a look at what they've achieved so far in 2021, and their EBIT margin is much higher. It's getting closer to this 40% range. And I also think that it makes sense to assume that over time, it will recover because as we could see historically, it was even as high as 44% in some years. It did fluctuate a lot. So this model obviously isn't going to be perfect, but over the long term, we can expect, just based on what we know historically, it will probably be around this range. So I have it growing at 0.25% per year. So 40% in 2021, and then each year it goes up 0.25% until it's about 41.5% in the year 2027. And then we take our taxes paid. So you have to calculate the tax rate. So I calculated the tax rate. That was the taxes paid divided by the EBIT here, because again, we're calculating against the earnings before interest and taxes, which it was about 21.5%. Sometimes it was 21, sometimes 22. So over the long term, I just assumed it would average to about 21.5%. So it's good when you're calculating the tax rate, just look at what it's been historically, right? Keep things simple. So it deducts taxes every year. Now, the next assumption is the perpetual growth rate. So this builds into our terminal value calculation here. So once again, just as a reminder, the terminal value, it is calculated as a multiple of the last year of free cash flow to firm in our model here. Now, the way this multiple is calculated is we could just take, say, 1 divided by this perpetual growth rate, which we're putting at 1%. So I'm essentially assuming from the year from after 2027 until the end of time, this company is going to grow at 1%. And the reason I put 1% is you want to keep it a relatively lower percent. 1% is really, it's actually quite high. Usually you'd want to have it about 0.5 or 0.75 of a percent, just because you're essentially assuming that the company's going to grow at that rate forever, right? That's kind of how the perpetual growth rate works. And this is the common methodology that's used in the discounted cash flow. You don't want to use anything that's 2% or higher than that. And the reason for that is because GDP growth is generally about 2% a year. So if you have, say, a perpetual growth rate of 5%, you're basically saying that the business is going to become worth more than the average size of the economy at some point, which is obviously completely illogical. So the way the multiple is calculated is you take the cost of capital and then you deduct that perpetual growth rate. So if we do 1 divided by that, it will tell us what our multiple is, which is 21 in this case. So the multiple is going to be a function of the cost of capital, which again is a function of the cost of equity and the cost of debt, cost of equity, which is a function of the risk inherent in the stock that you're looking to invest in. So that's what all this calculation is here. It's just this final cash flow multiplied by 21, which is about what it is. So that gives us our terminal value. And as you can tell, the terminal value, as a cash flow, because it's about $80.5 billion cash flow, what we're essentially saying with that is from after 2027, the total amount of cash flows that this business we think will generate is about $80.5 billion. And that $80.5 billion makes up a pretty significant amount of the total cash flows, or the free cash flow to firm in this case, that we're projecting for this company. You can see we got 2.8 billion in 2021, just under 3 billion, and then 3.1, about 3.3, 3.4, 3.6, 3.8, and then 80 billion. So most of the value that when you're doing pretty much any discounted cash flow analysis is going to come from the terminal value as opposed to these cash flows here. Now, I did a percentage of the year because if we're assuming we're investing in this company today, it's about the end of November as I'm making this. So we only have 1 month left in 2021. So this percentage of the year is just captures the remaining cash flow that we would get in the year 2021. And then it's 100% for all the years after that, including the terminal year. So then we get the prorated free cash flow to firm and then the discounted free cash flow to firm. So again, here's where we're discounting it at the rate of the cost of capital, which we already determined. So we can see if we go out to the terminal year, the free cash flow to firm, again, it's 80.5 billion, but the present value of that is much lower. It's only 5.7 billion. Now, a 5% cost of capital is quite low. And again, that's because, for one, interest rates are extremely low, because interest rates have something to do with, if you go back to our cost of capital calculation, interest rates are kind of what the risk-free rate is, right? If we say, what if they raised interest rates to 5% in the future? Well, suddenly our cost of equity is now 8.9. Our cost of capital is 8.44. And if we go to our DCF, now that future stream of cash flow is only worth 31.6 billion. So clearly the risk-free rate does have a pretty significant impact on not just Canadian National Railway, but equity prices in general, right? So that's why when you hear this news about the Bank of Canada thinking of raising interest rates and how that's bad for equities, that's why. It's because it builds into that cost of capital calculation that investors use for evaluating pretty much all investments that are out there in the public markets. So then we get here's the sum of the free cash flow to firm, kind of in the growth stage here. And then there's also the discounted terminal value, which is just this number here. Again, significant portion of the company's value, 57 billion versus just under 17 billion there. So that's our enterprise value. Again, because when we're calculating free cash flow to firm, what we're doing is we're calculating the cash flows that are available to all shareholders or all claim holders on the business. Then we have to add cash and investments. So I assumed this would be $1 billion, which is, it's really just a ballpark estimate. There are methods you can use to more accurately determine this, but just to keep things simple, I just put $1 billion in there. So that includes their cash balance plus any cash equivalents like short-term investments. And then you have to deduct total interest-bearing debt. Now, why is it that we deduct total interest-bearing debt? Well, again, we're trying to calculate equity value here because that's what essentially we're trying to determine the value of this company's equity, which the market is telling us it thinks it's worth whatever the market cap is. But we're trying to do our own independent analysis, given what we expect the future to look like for this company, to determine what we think it is and, make decisions that way. And the value of the debt decreases from that because it's a separate claim holder, right? We want to just calculate equity value. And as we saw before, if we go back here, enterprise value, it's the market capitalization, the value of the preferred stock, as well as any outstanding debt, and then a few other items here. Now, they don't have preferred shareholders, as we've discussed before. So all we have to do is just deduct the total interest-bearing debt. So all the types of debt that has interest attached to it, which again, I just estimated it to be $13 billion. It's going to be a higher debt balance in relation to their cash balance because Canadian National Railway is an asset-heavy business. They have a lot of long-term assets, which businesses will typically finance with long-term debt. Usually businesses will finance an asset with debt that matches the use of the asset. So long-term debt goes with long-term assets, short-term debt with short-term assets. So that gives us the value of the equity. We then divide that by shares outstanding, which our last assumption here is I'm assuming they're going to buy back about 1.5% of their shares outstanding every year until 2027, which gives them about just under 650 million shares outstanding. All these numbers are in thousands, so this is 650 million shares, which if you look at historically what types of buybacks they've been doing, it has been reasonable. So our fair value per share under these projections is only $96, and their current price per share is 160. So our conclusion for this would be that this company is priced a bit higher than where we would put it at based on what we think their future cash flows will be. So based on that, it does appear as if this company is currently trading at a high valuation. And a big reason for that is because they do have to pay very significant capital expenditures. So I'm going to go over here to the CapEx schedule. Now, this is essentially how I determined what their capital expenditures would be in the future and what their depreciation would be in the future. So you can see I got forecasted CapEx, forecasted depreciation. It looks complicated, but it's really super simple. I just took some historical figures here. I determined what their CapEx has been historically as a percentage of EBIT. And you can see it was rather consistent, kind of in that mid 50% range, and then took depreciation amortization as a percentage of CapEx. Again, it's pretty consistent, and then just took the averages of what those were. And then I used that, as we can see here, we can see I took 56% of their EBIT. So all the forecasted EBIT numbers that I have here. So these numbers here, I kind of just put them into the schedule here. This is just one method that you can use to determine this. And then it gives a percent, and then you can see there's the forecasted amount there. And then basically did the same thing with depreciation, just took depreciation amortization as a percentage of CapEx, and then use that to project what it will be going into the future. So yeah, based on our analysis, we have actually concluded that this business may be overvalued, which may be a bit of a shock, right? Especially by this much. I mean, we're saying that the fair value per share is only about $100 per share. Well, let me back this up and kind of qualify this a bit more just so it kind of makes sense. Let's look at some other valuation metrics, some more basic ones. So their current price to sales ratio is about 8, as we can see here. I'll zoom in there. So price to sales ratio is 8. The 5-year average is 6.3. So it's expensive in relation to sales. Their price to earnings ratio is about 24.4. And the 5-year average is about 20.6. So it's expensive there. Their price to cash flow, which is just referring to operating cash flow, 16.7, 5-year average 15. Again, it's more expensive. And then price to book, which is the book value of the company, is 5.3. The 5-year average is 4.8. So this company is expensive historically to where it's been in the past. Now, you may be saying, for a company like this, a great company like this, it's got a strong economic moat because it owns access to some of the most economically efficient transportation routes in all of North America, really. how does it make sense to conclude that a company with this strong a moat is overvalued? I mean, you should account for that moat in your valuation. Well, I have accounted for that moat in my valuation, which is accounted through the terminal value, because I've essentially assumed that this company is going to grow at 1% every year from 2027 onwards for the rest of time, which means the company's going to be around for a while, which is what you'd expect to see with a company that has an economic moat. Now, if we look at this company's stock price historically, let's take a look at the last 5 years and see if there ever was a time where it was trading around basically what we've projected it to be worth, so $96.18. So we can go back and just take a look at when that was. So we could see about here, kind of towards the end, kind of early 2017, it was worth about that price. Now let's take a look at what the company's historical financial statements looked like in the year 2017. Well, their free cash flow to firm was 4.7 billion. We can see their EBIT was about 5.5 billion, which it was about not that much higher than that in 2019, and it was lower than that in 2020. In 2021, it's probably going to recover and be closer to 6 billion. But you're talking about an increase of 5.5 billion in earnings before interest and taxes. Cash flow from operations, again, pretty similar, 5.5 billion. And then it is higher in the year 2020, but the stock price has gone up much higher than the increase that we've saw in their fundamental metrics here compared to that time. So in my opinion, based on the analysis we did, you would conclude that this company's stock price has run up a lot, and you can't really buy this business for less than it's intrinsically worth, just based on this analysis we did. But a discounted cash flow model is just one tool in an investor's arsenal. There are many others you can use. I personally think it's the best tool and a very important tool that you can use, because what you're doing is you're putting your assumptions about the business to the test. You can say with pretty good certainty that I think this business is going to go on and achieve these things. They're going to get these contracts, expand into this market, and do all this stuff. And I can back up the fact that I think this company is a good investment by building all that into a model like this, projecting all these things out into the future, and then determining what exactly their price per share is, comparing to the current price. And then you can make a good conclusion on whether or not you think it is adequately valued, undervalued, or overvalued. But anyways, guys, that pretty much does it for this video. So thank you so much for sticking around and listening to this video. I hope you did find it very useful. I will release this spreadsheet so you guys can take a look at it and perhaps use it for yourself in your own analysis. And I got plenty more videos like this planned, educational content as well as more investing style content. So with that in mind, I'll see you in the next video.